Welcome, everybody. My name is Joel Sinkin. For those who have been in my classes before, I still am Freddie, and welcome back to Elm Street. I'm the president of Transition Advisors. Today we're going to do a CPE class on two aspects: keys to have in your partnership agreement and different ways of partnership compensation plans, which belong ultimately in your partnership agreement. I know, not looking to make this all about our company, but to give you a perspective of why we feel that we could teach on this class. We're a consulting firm that the only thing we do are helping accounting firms in ownership transition. We've been involved in over 900 closings of accounting firms in different merger, acquisition, and succession plans over the last 25 years. I happen to be the AICPA's advisor on succession issues, write for the Journal of Accountancy, Accounting Today, all these places. The bottom line is, when you've done over 900 closings, many of them, if not most of them, require admitting new partners, amending your partnership agreement. So we've learned the hard way of what works in partnership agreements, what to avoid, and what are the keys you should have in them. These are just some members of our team. I don't want to dwell on them. Hopefully you'll recognize many of them. Bill Carlino, former editor-in-chief of Accounting Today, Terry Putney. What I want to focus on is a mission at hand. And as I always start, if there's 50 things you need to know about, in this case about drafting a partnership agreement, the smartest person in the room is going to think of 35. Again, why not 50, and why can't we even get to 50 today with an instructor? Because of the uniquenesses of every practice, the relationships of the partners, the goals that partners have. So we're going to focus on the quote-unquote norms, the general types of parameters you want to think about in addressing in your partnership agreement. Now, whenever you're drafting a partnership agreement, you really have 6 different aspects of it. There's a couple that are critical: compensation, governance, which is voting. How do we make a decision? Addressing death, disability, any type of retirement. Terminating a partner, unwinding the partnership. The last thing I want to share with you is a different perspective than I think a lot of people have when they focus on their partnership agreement. A lot of people say the partnership agreement's there to protect the partners. I've never agreed with that. The partnership agreement is there to protect the firm. See, the reality is, if the firm doesn't survive, it doesn't matter about governance, compensation, and buyouts. Your buyout's not going to get paid to you if the firm doesn't exist. So protecting the future of the firm should be a key part and the perspective we come from when we're drafting a partnership agreement. I used to ask how many people in the room have a partnership agreement. I've learned many people have a partnership agreement. How many have a signed partnership agreement is a very different answer. So let's hope that today we can get you a little bit further along in getting that partnership agreement updated and/or signed and drafted. Let's start with partner compensation. Let's keep it simple. What's your goal of partner compensation? It's to motivate your partners to behave in a certain way that enables us to get to the goals we've created in our firm. Professional goals, financial goals, growth goals, but this is what, in this case, compensation goals. And you want to be able to create a system that's someone who's really getting the job done times 2. They're a tremendous performer, that they're rewarded for this over-the-top behavior. And at the same time, help point out the non-performers and how we're going to get rid of or amend the non-performers to make them performers. And also, part of this whole thing is putting together a partnership agreement is how we're going to attract new talent, and how we pay our partners is going to be a big part of that. Now, there are 6 main types of compensation plans we're going to discuss today, and then 2 aspects that could impact all of them. There are more than this. There are many different compensation plans, and I'm not going to drill down in the total 50 minutes we have for this whole session, because you could do 4 hours just on compensation plans. I'm going to try and give you a brief overview of the 6 main ones that are used, and really more from a perspective of what's wrong with them. Where is the negative on them? What I think you're going to probably come to the same conclusion that many of my clients and my peers have come to, and that is, in many firms, maybe using a little bit of each type of program, maybe not all 6, but maybe taking the best of a couple different ones to create your own compensation plan might be where you end up going. Well, let's start looking at the 6, and then we'll talk about the last 2 bullet points that are up there. Let's start with the types of compensation plans, that being an equal one. It's exactly what it sounds like. We're all equal. We're going to make the same draw. We're going to probably make the same profit distribution. It's all good. We're all the same. A lot of times when a new firm is formed, it's formed in this way. Hey, the 3 of us, we're going to hang up a shingle. We're going to be equal partners. And people like it because it's easy. There's no negotiation involved. It's very easy to make it happen. There's 2 big negatives that you see that start to happen over the course of years, though, when people start with an equal one. 5, 10 years down the road, sometimes a year down the road, there's 2 big things I hear as far as issues. The first one is, what about the fact that we're not all producing equally? Now, let's not confuse what I mean by equal productivity. Some people might think that means, well, each of us should be doing the same amount of revenues, but maybe that's not each of our roles in the firm. Maybe you're the managing partner and you're supposed to be in charge of all the administration. Maybe you're also in charge of the quality control and making sure the work gets out and gets done and gets billed and gets collected and overseeing the staff. And as a result of all that, we expect you to have a smaller book of business, maybe less chargeable hours. So I'm not necessarily referring to the book of revenues each of us produce as far as being equal. I mean equally performing our jobs. But in the simplest of examples, let's say we are paid based on our book of business. If I'm doing $500,000, you're doing $500,000, and Paul Jones is doing $250,000, and we're still all sharing everything equally, and Paul has no other responsibilities different than ours, starts to get a little bit of an issue. So when you're getting equal compensation, it's great when everybody's basically giving an equal contribution, but it's very hard to sustain it. And over the course of years, it certainly very rarely gives anything extra to the high performer. Now, to show you how sometimes you could take one program and add something to it to offset that, if we all are a book of business type of firm, and one of us but we are still sharing things equally, maybe one way of helping to support the great performer is a new business incentive program. That if whoever brings in a new client, maybe they get 10% off the top for the first 3 years, whatever the number is. Think more about the philosophy than the numbers attached to this. Maybe that's a way to give that extra performer something extra, right? But what if it's not just, what about the high performance that did something to help the brand? That did something to change the technology and made you more efficient? It's hard to measure that. So there's lots of different things here that are hard to measure. At the end of the day, like I said, if we're not all equally contributing, sometimes the equal starts to cause some issues. Equity-based is another thing that's used very often when 2 firms first get together and has the exact same issues frequently that an equal one does. An equity-based might be something as simple as all 3 of us have a book of business. 2 of us are 500,000, 1 of us is $1 million. When we merge together, the one with $1 million is a 50% equity owner, the other 2 are 25% equity owners. So everybody thinks it's pretty easy because we created a system based on the book of business we all bring in. But what if 3 years later the 500,000 person is doing 800,000 and the $1 million person is doing 900,000? Are we changing it? Is every year are we going to reestablish what the equity is? So once again, just as in equal-based, it tends to make it very challenging for the things that aren't pure dollars and cents metric driven to measure them. It makes it challenging when people don't think we're all putting in equal contribution. Sometimes it could just be time. I'm working 2,500 hours a year, you're working 18. So there's many things that start to come up that make those 2 systems easy to get started, hard to stay on for the long term. A lot of people are pushing for these pure formulas. I call them the accountant's dream, because what they're trying to do is take out things that are subjective and make it objective. A great example, you're going to be paid on a combination where X percentage is based on your chargeable hours, Y percentage based on your realization rate, Z on the new business you brought in, A on the staff you're overseeing. So what they try and do is create different criteria and weigh it different ways so that there's this perfect formula that brings great clarity, great certainty that you're getting what you deserve based on your actual performance tied into this pure formula. Once again, though, the issues that start to come up down the road is some things are very hard to measure, right? If, for example, in your company, somebody became very high profile and started doing a whole bunch of TV interviews on a certain subject, created this special show during tax season that they were on PBS teaching, did a lot of the new business come in because that person brought the brand up? It's hard to measure. What if someone took you from paper to paperless and they were running that system? What if they got you on the cloud? What if they did certain things? How do you measure that? So it's hard, because even though you take away a lot of the subjectivity, not everything is black and white. And give any good accountant any formula, and they'll come up with a way to manipulate that formula. It's what we do. It's why I never work with Excel spreadsheets with accountants. I'm in their world. They're going to kick my butt. So you've got to think that the pure formula has its place, but can it be your 100% based on what your compensation plan is going to be? Cross-evaluation is a thing that a lot of the larger firms tend to do. And basically, they rely on partner X to review partner Y, and they're going to make certain allocations accordingly. All right? Sometimes they do it where, hey, there's four partners in the audit department, we'll have them look at each other. Now, of course, sometimes you also have one firm in Philadelphia and one in Chicago, the same firm and one partner in each, and how they're going to cross-evaluate each other when they're barely together, I don't know. But again, it has an appearance of fairness and democracy that people seem to buy into. My discomfort level with it is that it really requires great knowledge, intimate knowledge of the day-to-day contributions that each partner is doing. And because nobody wants to be the bad cop, you tend to lump everybody into the same average category. I don't want to say that the partner I'm cross-evaluating stinks. I should be getting 3 times more of the profit distribution than they do. Kind of, especially in the smaller the firm, the more challenging that becomes. But it is a system that a lot of people use. Not a lot of firms use cross-evaluation for the total compensation. A lot of them will use cross-evaluation for part of the compensation program. Again, as firms get larger, they tend to be more leader-driven. It's very hard when you have 30 partners to have 30 equal votes and make everything decided by those 30 partners. So a lot of them start to go to where the managing partner is the decision maker when it comes to compensation. And it requires a very strong managing partner, some managing partner that people feel comfortable, trust, think that they make lucid and fair decisions. A lot of people like the flexibility of it because of the fact that they can look at things that are less than black and white. They can take subjective things, what they did for the brand, the efficiency of the firm, training of people. So the more faith you have in the managing partner, more that could help. Simultaneously, if you hear the negatives, what is it? It lacks transparency. The more subjective something is, the more reason there is for someone to disagree, and a lack of trust can come up. Again, very large firms have gone to a lot of committee-driven formulas. Once again, not necessarily for all of it, maybe for part of their compensation, but a committee sits there and makes a vote on the contribution each partner has done. A lot of people like it because there's more than one person there. They get together. But a lot of people fear that not only the transparency issue not can it only be inefficient, but it can become a good old boys or good old women's club, where some people are more friendly than others and they're going to give them the benefit of the doubt. Again, like all of these compensation plans, they have their great positives and they have their great negatives. All right? Now, 2 aspects that impact compensation plans, and in a moment we're going to talk about how to bring this all together, so to speak. But What you have in a lot of these situations is an eat what you kill formula, and other firms have a one firm concept. I'll give you an example. You have a firm like Rothstein Cass. Great firm, New Jersey, New York, California, big player, top 25 firm in the country. There isn't one person that you'd ever hear sit there and say, this is my client at Rothstein Cass. Everybody's client at Rothstein Cass. They take great pride in the fact that you might have three different partners handling the same client, but this one handling this aspect and that aspect, because it's whatever's best for the client. They may have one person bring in a new client and never deal with that new client again because they may have the initial relationship, but they felt someone else was more expertise in servicing them based on niches and specialties. Other firms are very much eat what you kill. A lot of the smaller firms are eat what you kill. And what we refer to there is maybe we all agree that our net's 40%, and therefore 40% of the book of business I manage is what my income is. So one of the first things you have to decide you're going to be is, are you going to be an eat what you kill firm, where we each have our own book of business? A lot of people call it a book of business firm. Or are we going to be a one firm client type of thing? Right? Positives, eat what you kill is real easy to calculate. It's very black and white. Negative, it does promote my client versus firm client. It makes clients more partner loyal than brand loyal. It makes succession more challenging because a client's really in bed with one partner instead of multiple partners. So there's less, again, brand loyalty. All right? So there's great aspects of it, and there's very challenging aspects. One of the things that you tend to see is as firms grow, they try and get away from the eat what you kill and more to the one firm concept. But I will tell you that if there is a trend right now in this, it's the one firm concept. It's to get away from it even on the smaller firm basis. One of the other challenging aspects to decide in a compensation plan is whether or not it's going to be an open plan or a closed compensation plan. Many large firms use a closed compensation plan, where either just the compensation committee, or if it's a managing partner, leader-driven compensation plan, is the only one who really knows what other partners make. And I will say to you, that's a big trend in larger firms, to go to the closed compensation plan. If the partners trust the system and the decision makers, it's a very effective tool. It enables people great flexibility to compensate people based on what they perceive as their talent. It enables more flexibility when you're bringing in talent, when you're doing a merger. See, a lot of firms who have grown a lot by mergers, if everybody knows how everybody's compensation works, and then suddenly there's a merger we really want to do, but to bring this partner in, this partner makes 30% more than almost every other partner in the firm. If everybody's going to know it, they're going to say, how come that partner's making that much and I'm not? Maybe I'm looking to bring in someone who's got this really great niche, but they have great experience. They have great relationships. And they're making $500,000 net on $1 million. And in order to get them in, I got to keep them whole in income. But everybody else is only making closer to a third of, or to 40% of the book they manage. When it's closed, nobody knows that. People can make decisions. People have more flexibility. But again, it lacks transparency. So this is an overview. You have the 6 main plans. There's lots of others, but those are the main plans. And then you have the basic fundamental things. Are we going to be eat what you kill or one firm? Are we going to be a closed compensation system or an open where all of us know what people are getting? There isn't a right or a wrong. They are what they are. But I'm going to show you in a few moments an example of how some firms have taken this and brought it to a level where they actually use bits and pieces of more than one system. And I'm going to give you an example of a very effective one. But let's get back now to drafting our partnership agreement. And I'm using the term partnership agreement, but let's understand, if you're an LLC, it might be an operating or membership agreement, okay? If you're a PC, it's a shareholders agreement. We're just using the term partnership, even though it might be a stock agreement. Let's just be comfortable when I say partnership agreements, regardless of what entity you have. My starting point when I'm consulting with a firm to help them draft a partnership agreement or amend theirs is, what does equity mean? Some firms, equity means everything. Your voting is based on your equity ownership. Profit distribution is based on your equity ownership. Your buyouts based on a multiple times your equity ownership. Everything is equity. Other firms, equity means nothing. And I'm going to give you an example to tie some of this together. And I won't use names of firms because it would be a little embarrassing for them. And they're really smart people that just kind of fell into an old trap that a lot of people do. There was a pretty large merger done 2 years ago on the West Coast. One firm was over 40 million. Let's just, for the purpose of numbers, say they were 42 million. The other firm was 8 million. Big merger. They had met on their own. They had worked out everything. Compensation, voting, everything. The only thing they didn't work out was equity. The larger firm felt they had a much better brand. Their realization rate and average billing rate was better. They had put a lot of money into infrastructure and technology. And what they started the negotiations when it got to equity was saying, look, our firm's worth more than yours. So what we should do is our volume should count as 100%, and your volume should count as 80%. So therefore, instead of it being a $50 million firm, that you have $8 million, therefore that's how we're going to calculate your equity. It should only be 80% of 8 million, but we should still count as 42 million. Well, the smaller firm said, what do you want to merge with me if I'm your ugly stepchild? If I'm that horrible and you want to devalue me, what's the value in merging with me? And it became a major issue. And the two of them made a decision, the two managing partners of the firm, to hire me to be King Solomon. They said, Joel, we want to do the deal. We want to merge together. We've worked out everything. We can't get past this issue. We're signing on. You make the decision. We'll say yes, and we're going to close this deal. So I agreed, and the first thing I asked for was they had already told me that they were going to use the successor firm's partnership agreement. So I asked for a copy of that. That was my first thing I wanted to look at, and then I said we'd talk after that. So I get the partnership agreement. First thing I look at in the partnership agreement was governance. How do they make a decision? How do they vote? In their partnership agreement, it was one partner, one vote. If you owned 1% or 50% equity, you got one vote. So I said, okay, equity doesn't mean anything there. Let's move on. I went to profit distribution. In their firm, they used 3 different compensation programs of the ones I kind of just mentioned before. Great example, as I said. 1/3 of the profit available to be distributed was distributed equally to all partners. 1/3 was based on a compensation committee that subjectively rewarded different people on their compensation. And the last third was based on a pure formula that had metrics that applied weighted different systems, realization rates, chargeable hours, new business development, etc. So, but when viewing their compensation program, equity meant nothing in compensation. So then I went to the third aspect of their partnership agreement, and that was buyouts. I wanted to see, how did they value a partner's equity when a partner was retiring? There was nothing about equity. The way that firm worked, which by the way is traditional to 98% of the top 100 right now, is their buyout was based on compensation. Their particular firm looked at an average of your last 5 years' income per partner on an accrual basis, took the 3 highest years, averaged it, multiplied that by 2.75, and paid that amount out over 10 years on a K1. And since your purchase price was based on compensation, and compensation wasn't based on equity, brain surgeon I'm not, my kids will definitely tell you that, but I quickly came to a very simple conclusion. Equity doesn't impact decision making. Compensation, voting, decision making, or the buyout, why are we fighting over equity? So I called the 2 managing partners about 2 hours after I got the partnership agreement. I got them on a conference call and I said, listen, I'm trying to figure out what we're fighting about. Unless we dissolve the firm and we have to decide how to liquidate the assets, or unless we could find somebody, which isn't going to happen, that's going to come in here and write us a big fat check to buy our business, equity means nothing in the firm. Why are you fighting over it? We all laughed, they thanked me, they hung up. The easiest $5,000 I ever made in my entire life. In that firm, equity didn't mean anything. So you as a firm have to make a decision. Are we going to be equity driven? Is it going to affect the criterion you have on your screen right now of compensation, profit sharing, decision making, buyouts? If it does, how you calculate equity is going to be very, very important. If equity has little to no meaning, stop worrying about it. But that's your starting point in a partnership agreement. Now, one of the trends you're starting to see are a lot of different types of partners in firms. I gave a couple examples here today. Full equity partner or a senior partner. It could still be a full equity partner but a junior partner. An income partner, which is sometimes called a contract partner or a profit partner. An of counsel partner, or using the term principal. So let's talk about that. And when do people use it? A senior equity partner might be a firm that has a vesting period. That once you're a full equity partner, if you're a full equity partner under 10 years, your buyout maybe is 2 times comp. And once you've been a partner for more than 10 years, it's 2.5 times comp. Maybe that is just one silly example, but a real one. So a senior equity partner versus a junior equity partner might be based on, in some firms that are more eat what you kill, the book of business you manage, the profitability, your tenure, your vesting. But these are decisions you make when you create your partnership agreement. An income partner, contract partner, or profit partner usually is a title that's given to someone who has no equity. Most of the time, what they do get is participation in the profitability of the firm. A lot of people use it as an interim step to get between manager and full equity partner being a contract or income partner. I've seen firms that actually said to an income partner, you too get a buyout. Maybe it's 50% or even 1/3 of what a senior equity partner or full equity partner might get. By the way, most firms don't have junior and senior full equity. It's either equity or some of these other titles. So, but I've seen the use of income partners before. Now, some of the great advantages has relates back to M&A, back to attracting young talent. For example, you might have a firm that says, you know what, in order to be a full equity partner, not only do you have to be here a certain period of time, which we may grandfather to someone we merge in, we also have to be managing a book of business not less than X, 500,000, $1 million, whatever that number is. Let's say it's $1 million, and let's say there's a great young partner that we're trying to recruit to bring in who owns their own practice. They're doing 600,000. Are they going to go from the owner to a manager? They want that title of partner. Maybe one way of giving it to them is having a different category of partner, income partner, where they can come in as a partner, but until they're managing $1 million, they're not a full equity partner. It's a great settling place for both training grounds and to attract certain talent that don't want to go from being an owner or a partner to a senior or manager or something like that. Of counsel partner is a term traditionally used for a retired partner who's still putting in some time, but basically that usually means they've surrendered their equity. A great term that we get away with in the accounting world is principal. Same in the legal world. In layman's society, a principal is an owner. In the accounting and law, a principal usually denotes a non-equity partner, a non-owner. But it's a higher level. And once again, a lot of times it's a landing place before someone becomes an equity partner. It could be, again, a promotion for an internal person to principal. It could be a way of bringing over an equity partners. You know, the 10,000-pound gorilla situation, we'll talk about it in a little bit, but 3 partners of a $2 million firm, 2 own 45% each, 1 owns 10%. That 10% they own is what, $200,000 book of business? But are they going to go from being a partner in a $2 million firm to a senior in your firm? maybe giving them the term of principal or income or contract partner is a way to bring in that talent, groom them to move up without making them feel like they've been demoted. All right? The next aspect of a partnership agreement relates to voting. It's a pretty simple one, governance. One of the things you want to be careful of is having analysis causing paralysis. So what most of the time we do when we're drafting a partnership agreement is break decision making into three categories: unanimous, supermajority, simple majority. And a lot of times that's the line that draws what requires supermajority versus simple might be a financial commitment. But let's look forward and give you some examples. Supermajority. In some firms, by the way, that could be unanimous, but the admission of a new partner. By the way, let's talk about definition of a supermajority. Some firms use 67%. I've seen it used as high as 80%. A lot of times it depends on how many partners you have. I mean, if you have 10 partners, you might say 70% of us is enough to do it. Right? These are personal decisions, but supermajority is usually someplace between 2/3 and 80%. But admission of a new partner may require a supermajority. A simple majority might be something as simple as a revenue expenditure over a certain level. I'll give you a couple of examples. In a 6-partner firm I recently helped out in the Midwest, they put in a situation that any partner can authorize an expense up to $2,500. Any partner, it takes a simple majority of partners to authorize an expense between $2,501 and $7,500. Anything above $7,500 required a supermajority. Now, I will tell you one of the tricks we did in that particular thing came from a very hard lesson that I learned a couple years ago. More than a couple years ago, it was probably 20 years ago. There was an agreement that basically said that any partner can write a check for, can write a check up to $5,000. And there became a big issue at a firm when a partner hired somebody for $50,000 a year. Everybody freaked out. How'd you do that without a decision? So, well, the check is only $1,000 a week. We had to change that from how much of a check you could write to how much of a financial commitment. I mean, hiring someone, signing a lease, you might sign a lease that's under $5,000 a month, but it might be a $150,000 expense that you've just committed the firm to. So what requires super, simple, unanimous? Some people will use admission of a new partner, a merger, a sale, a termination. Another great hard lesson. There was a arbitration case. I was asked to be the arbiter, and it didn't last more than about a minute or two when I told them all how stupid they were. But what happened was there was a clause that it required a unanimous vote to terminate a partner. They forgot to say except for the partner being terminated. So of course every time it came up for vote, he said, I don't want to be terminated, and it wasn't unanimous. So sometimes common sense helps a little bit in drafting these things. Now, retirement is a very big part on how we address it, how we compensate it, how we handle it in any partnership agreement. I want to start with mandatory age for retirement versus vesting and the general concepts of both. It was only 10 years ago. It was a very rare time I ever saw a mandatory retirement age in a partnership agreement. Very rare time. Excuse me. And they were predominantly larger firms. Now, it's a rarer time that I don't see it. There's a genesis of where it came from. We have aging partners. We have the baby boomers having a huge impact in our succession planning for an accounting firm. So one of the greatest commodities in all of accounting today is young partners with a book of business. So there's a huge competition to attract young partners to bring them into your firm to build an internal succession team. Well, if you're 35 years old and you've got a $1 million book of business and you're trying to decide between two firms, one firm has mandatory retirement age at 65, one has no mandatory retirement age. Which one are you going to take? Unless there's some other compelling factor, I can tell you to the day that I have a chance to step up in the firm with the mandatory retirement age. The other one, I have no idea. I know a lot of people that are 75 years old that call me up and say, son, give me a call in 10 years. I'll be ready to slow down. I might need your help. This isn't a physically demanding job. And what do they say? The new 70 is the old 60, or all these different types of numeric equations like that. So the problem here is we wanted to have a tool to let people know there's a light at the end of the tunnel. It's not an oncoming train, and you're going to get to step up no matter what. That's the mandatory age reason. I'm not saying you should have one. I'm sharing with you why some firms choose to. What kind of annoys me is we've left vesting behind in a lot of places. And I'm going to give you another example of where I found it to be distasteful. I helped a firm in our Boston office about 3-4 years ago. Actually, probably a little less than that, forgive me. But what basically happened was there was a two-partner firm. One partner was 61, one was only 50. We were merging them in. And the gentleman that we merged in who was 61, 4 years later was going to retire at 65, which was this particular firm's mandatory retirement age. They vary. And he was going to retire at full benefit. Well, at the time we were trying to finalize that deal, we had a partner in the successor firm who raised their hand and said, listen, I got an issue. I know this is lousy timing, but I have to tell you, I've been thinking a lot about my future. I was made a partner in this firm when I was 38 years old, and I'm 58. And I've lost my passion for it. And my alma mater reached out to me and asked me if I'd be interested in a teaching job. And I'm very interested in taking on this teaching job. But we have a penalty in our firm. If I was to retire before 65, I have to retire by 65, but if I retire at 58, I get a lower valuation. Yet I've given 20 years as a partner, 30 years as including employee time, as being in this firm. Now you're telling me you're going to merge in someone who's going to be here 4 years is going to get the full reward, and I've been here for over 30 and I'm not? And what that day we did was institute a vesting policy as well. So now in a lot of mergers, as this gentleman was 61, we gave him the vesting period, recognizing the time he was a partner in the other firm. What I meant by a vesting period, there was once you've been a partner for more than a certain amount of years, each year you got a higher percentage of what the total purchase price would be. If you were a partner for 5 years, in this particular firm, you got a third of whatever the partnership buyout would be. If you were a partner for 10 years, you got 2/3, and once you were 15 years or more, you were fully vested, but you had to retire by 65. They used a combination of both, a pretty interesting formula to use. One of the real challenging things to do that people need to think about is most partners, when they hit that 65 or 68 or 62 or 70 or whatever the mandatory retirement age, or heck, even if there's not a mandatory retirement age, they just want to slow down and they surrender their equity. Many partners stay on in an of-counsel role. How do you compensate them? One of the things we used to do was we used to have an hourly rate. We had per diem rates. We had, we're going to pay you X dollars a year and you're going to be of counsel. Had some headaches, not big issues, some headaches. Sometimes a gentleman who retired would call me up and say, you know, I know they're paying me $75 an hour, but I got to tell you, they've made me feel like a clock-punching employee. I'm so accountable to tell them every minute of what I'm doing. It's driving me crazy. More often than that, I get the call from the younger partners saying, hey, I love it when Jack comes into the office and puts in some time. But when he comes in and he puts his feet up on the desk and I'm paying him, it's driving me crazy. We switched it to paying our partners, retired partners, a third of what they're billed out for on most assignments. Sometimes as high as 40%. Right? Here was the theory behind it. We don't ask a partner to come back in to do a bank rec. We're asking a partner to come back in. It's usually the highest chargeable rate we're going to get. If we could bill them out at $3.30 an hour, we're going to pay them $110, maybe more. If they would have asked us for that much an hour, we probably wouldn't have given them an hour. But the third works even more. Why? Number one, what are you trying to do as an accounting firm with labor? You're always trying to triple labor. If I pay a staff person $50 an hour, I got to bill them out at $150. So I'm tripling labor. I'm getting the retired partner a good rate, probably. And from the successor firm's perspective, I'm not paying for non-chargeable time. It's been a very effective tool. Now, other parts of retirement that you need to think about is how we value the equity. Most of the larger, small to large regional and national firms now value equity on a multiple of compensation. Most of them will do a formula, something like an average of your last 3 to 5 years income for a partner. Most of them will use a buyout figure between 2 and 3 times that. Most of them will use a payout period 8, 9, 10 years. Most of them will pay that retirement on a K1 type of thing. Plus capital. Capital a lot of times is paid out in half the time versus the purchase price. All right? Some firms still will base it on a multiple times your equity interest. I own 20%, the firm's $1 million, it's a one-time multiple, payout's 5 years, they're going to pay me 40 grand a year for 5 years. All right? So those are the two most frequent ways to do it. Right? Some people feel that they need to fund the buyouts for their partners and start to fund it and put it away. I'll tell you that I get the question all the time, should we do it based on equity? Should we do it based on compensation? I say you should make that decision, but it should pass a litmus test. The litmus test is based on a theory that nobody buys a business to lose money. Your partners should not buy you out and make less money. So here's the litmus test. Let's say as a partner in the firm, I'm making $300,000 a year, including perks, benefits, the kid's cell phone. Let's say it costs $100,000 to replace my labor. Well, now there's $200,000 left for the firm. How much of that do you get? How much of that do I get as the retiring partner, and for how long? Because based on that, I'm getting paid for my years of sweat equity. You're making more money. If you use equity times multiple or compensation multiple in your buyout, as long as it passes that litmus test, it works. And then you don't need to fund it. See, the idea of pre-funding means there's less money for us to distribute today. I don't like that idea. I want to spend everything I can today and save what I decide to save. If my buyout formula makes sense, it's self-funding. I don't need to advance the funding unless there's a tax trick I'm trying to use. So these are some of the things you think about when it comes to valuing the whole thing. Other things you need to think about in valuing it is how long is a payout period? You know, the larger the firm on an internal sale to partners, usually the longer payout period. 8, I've even seen 12, I've even seen 15 years where it was done as a goodwill transaction. Some firms have a retention period. Those are usually partner loyal practices, or a firm where maybe it requires 2 years notification before you retire, and if you fail to give that notification, there's a retention period that adjusts the purchase price that the firm owes the retired partner based on client retention. You can't value that without looking at the tax ramifications. Is the firm getting a current deduction? One of the things I try and do all the time, and this goes back to the concept of protecting the firm, is I like to put in a cap of what's the maximum amount the firm can pay per year for retired partners' purchase prices. Maybe the cap's based on the gross, maybe it's based on net or EBITDA. I like basing the cap on the gross, it's easier to measure. The smaller the firm, the higher the cap percentage might be. Maybe it's 20% in a small firm. Maybe it's 3% in a national firm. Maybe it's 5 to 10% in a regional firm. Basically what it says is, hey, all of you are supposed to get your payout over 8 years, but let's say the cap was 10% randomly. If there's a year where the retirement payments would have exceeded 10% of our revenues, in such the excess will be deferred to a subsequent year. I'm not telling someone they're going to get paid less. What I'm doing is protecting the profitability of the firm, because if the working partners can't pay their mortgage, they're not paying your purchase price. We've got to make sure this makes sense. So I'm a big fan of caps, just as I'm a big fan of notice. I alluded earlier that I like at least a 2-year notification. I prefer 3 or 4. That we say to someone, hey, 2 years from now, I'm going to go to counsel. So we're going to spend this next 2 years transitioning the relationships of the clients from me to who's ever going to be managing each client. It's probably not going to be one partner taking over all my clients. It might be a manager taking over these 2 and this partner taking over these 6, but we have to put in a transition plan. We have to create notice. And lack of creating notice means an adjustment if a client is lost. You need to address death and disability in your partnership agreements. It's a very important factor to have. Let's start with disability. Another war story. About 18 years ago, there was a partnership agreement that said if you were disabled for 90 consecutive days, you went from temporary to permanent disability. On day number 78, this wife wheels in this husband on a wheelchair with an IV bottle, leaves him there for the day, picks him up at the end of the day, brings him home, and they take a case that the 90 consecutive days has to start all over because he was in the office for the day. Ludicrous. True story. One of the things you might want to do is decide, when does temporary disability become permanent? Maybe it's 4 months. Instead of saying 4 consecutive months, be smart. Say 4 out of any 5 months. Protect yourself a little bit. But you have to decide, when does temporary disability become permanent? Usually you'll have language that if a doctor agrees that this person's permanently not going to recover, day 1 they could be considered permanent. How do you compensate someone during temporary disability? One of the ways I like to do it is say, and a lot of firms do, is the first 90 days, we're going to pay you your normal comp. Next 90 days, your normal comp less any company paid disability policy until you hit the point of permanent disability. One of the things I also like to add that a lot of firms don't like is I like to add less the cost of replacement labor. See, nobody gets disabled in November. Everybody gets disabled February, March, middle of tax season. Then I got to bring in all sorts of heavy hitters I got to pay during this temporary disability. So the partner who's disabled is going to make the same money they made before, and all of us are going to make less? Makes no sense to me. So to me, it's your normal comp less the cost of replacement labor, if any. Disability, you treat like death when someone's permanently disabled. Death, hopefully you have insurance that covers it. One of the tricks that a lot of people have done for tax purposes is have the partner's family own the policy. So it's not a taxable event going from the firm to the estate, and put in a very low cash buyout for a partner. Make sure you check that policy all the time, making sure that the death benefit equals what the purchase price should be. If you can get insurance, you can't always get it. And one of the other things I like to do is, let's say there's a shortfall between the death policy and what the buyout should have been. Buyout should have been $1 million, we only had $750,000 in insurance. I like to defer the $250,000 the firm owes the estate for a year. We just gave them $750,000, they're probably okay. But the firm has to replace a partner that died suddenly. We might have a problem. We might need that time to get it done. Termination is something that, again, usually requires either a supermajority or unanimous without including the person who's being terminated. Make sure that you have an agreement of what constitutes a cause. Some people just put, we could terminate someone for cause. That won't hold up. But there are legal definitions that you could put in for cause. Make sure you have non-competes that make sense. Okay? You can't say to someone, if I terminate you, you get no buyout, you have no right to compete, you can't hang up a shingle, and you can't take a job within 30 miles. It's not going to hold up. All right? It's just not going to hold up. You have to be realistic. Different states have different regulations about what kind of non-competes you have. Make sure you have a local attorney who's giving you good advice about what's the strongest one you could have that's enforceable. Right? These are the types of things you need to think about. Couple of last-minute thoughts. Remember, an external sale and a dissolution usually requires a supermajority, and it's something that needs to be put in your agreement. I like putting in roles and responsibilities. I like to put in saying that, everything's not just your book of business. I like people to know what success looks like, what your role is, and what does success look like. You got to make sure that if you bring in a partner, that they agree to hold you harmless and indemnify you for services provided or should have been provided prior to the time they became a partner. And you're going to hold them harmless for other things. We already talked about non-competes. If there's a dispute, I'm a big fan of arbitration versus lawsuits. When there's a lawsuit, the only person who wins is the lawyer. Arbitration's a good way. And let's have realistic restrictive covenants. If someone decides to leave, can they leave with clients? Maybe clients up to their equity interest? Do they get a buyout if they can't take any clients and can't hang up a shingle? Can they purchase clients if they want to take them with them to another firm? These are all options, not one is right or one is wrong. It's what the personal options you decide. And to give a couple of last minute things, remember, partnership agreement's a living agreement. One of the big problems a lot of people have is they don't have one or they don't have one signed, and those that do haven't looked at it in 5-10 years. Then they realize a lot of it's obsolete. At minimum of once a year, every partnership agreement should be reviewed by the partners. And there should be a meeting to make sure we're all still on the same page. Limit how many partners can retire at the same time. It's not a financial thing, but if we're a 4-partner firm and 2 people want to retire within a year of each other, if it passed the Litmus Test, we can afford it from the cash flow, but how are we going to replace 50% of our partner team? So put in something. Depends on the size of your firm. If we're a small 5-6 partner firm or less, maybe no 2 partners can retire within 2 tax seasons of each other. And what that means is I gave you my 2 years notice, I'm 6 months from leaving, and Jane got hit by the bus, I've got to maybe defer my buyout now. And remember to try and create benchmarks, what success looks like, time frames. And lastly, in your partnership agreement, remember it's not just one partner retires, somebody else comes in. You got to make sure that they have the expertise, the capacity to assume that role. We're not just replacing a body, we're replacing a role. There are many aspects of partnership agreements, many things to think about. We've only addressed as much as we could in a short period of time. On our website is a resource section that has drop-downs that has reports, white papers, case studies, give you insights on more. There's our email address. Give me an email. You have a question through this organization or directly to us, we'll do what we can to respond. I want to thank you all very much for giving us this time today. I hope it brought value to you all. Make sure you get that partnership agreement signed. You don't want someone's partner who's spouse becoming your partner. You don't want some lawyer deciding who's right or who's wrong. Have a partnership agreement that makes everything clear and concise. Thank you all. Have a great day.